welcome CoinDesk crypto mining reporter, Aoyon Ashraf.
Good morning. How are we doing today? Oh, looks like a lot of you had a lot of fun last night, which is good because the fun continues today at the mining exploration stage. Hopefully you have your Gatorades and coffee ready. We're going to go do a deeper dive into mining and the issues that we're facing today and what the outlook is going forward. We know what happened last year. There's a ban which migrated a lot of hash rates into U.S. and a lot of other countries. And then there was a bull run. Investors poured a lot of money into mining public equities. And then 2022 happened. Hash rates went all the way up to all-time highs. Markets went down, and ESG mandate became a huge debate. And we're going to go through all these issues today and see what the future holds for the industry. So first up is mining finance. Everyone wants to know about that one. What's going on? Joining me would be Jaime Leverton from Hut 8 CEO. Fabiano, head of mining at Galaxy, and Lucas Pipes, investment banking, B. Riley's managing director.
Well, there you go.
All right, let's get right into it. Jaime, I'll start with you.
All right.
You've been through the last cycle of bear market, and now we are here. So just briefly explain to us what you have seen before and what you're seeing now. How is it different, or is it not different?
Okay, big question. We became public in 18, so the middle of the big bull run, 17, 18. Obviously survived the bear market, and now we're in a new bear after the bull last year. So I think there's a lot of things that are different. Obviously, the signal's getting a little bit more cloudy. There's a lot more institutional interest in this space. There are a lot more options as far as financing. We now have, I think the number is 30 publicly traded digital asset miners, which is very, very different from the last cycle. We spent quite a bit of time last year diversifying, so we have different revenue streams. We're not entirely focused on the Bitcoin mining side, which I think is helpful in a bear market because we have other sources of fiat-based revenue.
Is that a strategy that miners should look at, diversifying?
I think miners have different strategies. I think investors need to figure out what resonates with them. Not all miners are created equally. I think we were the first miner to hold Bitcoin on balance sheet starting back in 18, and we continue to do that today. Now we have over 7,000 Bitcoin on balance sheet, all self-mined. And I think the nice thing about having a stack in this market, in bear market conditions, our stack currently is unencumbered, so it gives us a lot of optionality from a balance sheet perspective. And there are obviously, my partner here at Galaxy has been very good to us. There's a lot of options. We work with Galaxy quite closely, so I think this bear market is the most interesting for us because we have such a diversified business, such a strong balance sheet. I think there's going to be a lot of opportunity for growth over the next.
I love that opportunity. On that note, Amanda. It's your call. What are the opportunities are there in this bear market cycle, and what the investor should be looking at?
Yeah, this bear market cycle I think is a little bit different than the last one. I think the last one, the miners that survived were the ones that held Bitcoin. We saw that, and over the last year we had a lot of public miners come out trying to get that liquidity, and I think that they really didn't realize how difficult it is to build, right? So for me, I think investors should be looking at what miners are actually delivering on what they say they're going to deliver on.
Gotcha.
That's a massive thing.
I have a slide over here that kind of explains. If you can get the slide on the screen.
Wow, am I smart?
There you go. And you can figure out where we are in that cycle. Sorry.
While am I smart, right, was probably last year. And I think we're probably in the desperation panic phase now. I don't think we're in full capitulation phase.
No.
And you don't have to be. as miners, you can become extremely like aggressive on things like treasury management, which will set you apart. And I think that that's one thing that is really, really important in this next cycle.
Gotcha. Lucas, what are your thoughts on it?
So, I mean, I would echo much of what has been said, but what I would say from an investor's perspective is really important is production. Investors have very little attention and patience these days for concepts. They want to see coin production. There have been missteps on the execution side. There have been, unfortunately, some miners that just didn't get up to scale fast enough and needed more capital to get up to scale. And so investors are focused on, show me the coins. Show me the coins. Every month they want to see that.
It's a show me a story right now.
Yes.
Gotcha.
Can we
Amanda?
talk about capital for a minute?
Yes, please. Go
Okay,
ahead.
just because I'm very excited about this today. So we do a lot of research at Galaxy on public miners, which allows us to have a very unique position to finance miners. And we also are a proprietary risk taker. So when we give you terms, it's coming off our balance sheet, which is very different than some other lenders in the space right now. And I think that that's a really important thing for miners to focus on. But capital is very interesting. So with our research that we've done, we found that a sample set of public miners, they still owe $1.9 billion this year for the ASIC purchases that they've committed to. Where is that money coming
That
from?
1.9 billion is still left.
Correct.
Wow.
And that's just the ASICs. That's not
It's
the
just the
infrastructure.
ASICs.
Well,
Exactly my reaction.
The audience is giggling.
I think we're in panic
We're
mode
getting
there.
there.
Yes. Yeah.
I think that's desperation.
So how do we solve that?
So I think that this is where the treasury management strategy really comes in hand, right? So
I'll ask that to Jaime as well. And I mean, you're a mining company. How do you solve? If I'm not talking about Hut 8 specifically, but how would you how does a mining company solve that?
Well, I think a mining company has to prepare for the bear market in the bull market, right? If you weren't thinking about the cycle management, balance sheet management, treasury management last year, then you're in a really difficult spot.
Speaking of difficult spot, so are the investors. So when Amanda, you're an investor, so if I'm a miner and I come to you like, Amanda, I need money, what are you looking for to tell me yes or no?
So what separates you from every other miner in the space, right? We're all kind of doing the same thing, and we are also doing it on our end, right? Like I'm a miner. We have our own prop mining operation. And the question I always have to ask myself is, are you doing something different and better than what I could do with this capital?
Right.
And Lucas, you obviously talk to a lot of investors. What are they asking you about miners?
Yeah, so I'd say the number one question is liquidity, right? Is there enough capital in this company to get through the cycle? And so I do a lot of sensitivity analysis with investors who are like, run this model at 25,000 BTC, run it at 20. Do they run out of money? If they run out of, if there's a capital shortfall, how can they plug it? So Amanda touched on some of those points. Equity is technically available. It's just really, really expensive. There are some companies.
How expensive are we talking about?
I mean, so how much dilution are you willing to bear? You're.
I mean, you can't raise equity anymore, so we're talking.
Yeah,
debt.
there's some that public companies that have an ATM out there that are using them. So there's a bit of equity out there, but I think you're looking increasingly to equipment financing at very high rates.
I have this one slide that talks about how miners are selling Bitcoins that they mine at a record number in recent years. So is that also a part of the strategy for capital? I'll leave it that to everyone who wants to answer that, including you, Jaime. I know you're not doing that, but still, is that a strategy that investors would like or like to see, or how does it work in the miner's point of view?
I would say investors would like to see a proactive management of the balance sheet, and that includes selling Bitcoin. It's viewed as a form of capital. I would say institutional investors are not married to that Bitcoin. It's capital. It's fungible. If you have a better use for that capital, buying ASICs. Use that capital to buy ASICs. So I think there's a very pragmatic approach to that capital.
But there's other things that you can do with that Bitcoin, right? Like you can hedge it, you can lend it, you can create like hedging solutions that allow you to get more access to institutional capital because they see you as someone that is doing the right thing by balance sheet, right? So I think that there's a lot of different ways that miners can get creative with it. And, you know, to shill Galaxy a little bit, because that's why I'm here, we can help miners with all of those bespoke solutions. So what we do is we have our own prop mining operation, like I said, and we're able to really understand what a miner needs and what a miner could utilize and really create a bespoke solution around that so they don't have to sell their Bitcoin if they don't want to.
Jamie.
Yeah, well, I think everybody knows we started a yield program with our balance sheet last year with Galaxy and with Genesis. We've used our Bitcoin as collateral to raise debt in the last bear market. Right now, our stack is unencumbered, but that allows for a ton of optionality in this market where we can put it to work without selling down. And
Talk a little bit about the optionalities.
Well,
without giving out too much.
I mean, we've been one of the most active miners as far as how we manage our stack by having yield programs last year. I don't think anyone else had a yield program last year of the publics.
I'm not aware.
No. So we put our stack to work, which gives us a different form of revenue. Again, without selling down, and we have used it as collateral. We're not using it today, but the optionality remains there. I think the ASIC pricing is not at the bottom yet, so I actually don't think this is a good time
So
to
it's still
buy.
not at the bottom. What would be the bottom?
Well, the first ASICs we bought for the bull run, we paid about $18 a terahash.
Beautiful.
So right now at 50, I don't think 50's spot right now. I don't think 50's the bottom.
Right.
So would I sell Bitcoin to buy ASICs at 50 landed? No, I wouldn't.
That makes sense.
Even though Lucas might want me to.
No, what I'm saying is use the capital for whatever is the best use.
Right.
So if you can make a good argument that this capital is better in Bitcoin on your balance sheet, by all means. But if the opportunity cost is not making that last payment to
I
the
agree.
supplier, you know, run the math. What's your return buying a machine? What's your return keeping it on the balance sheet?
Right. We are in the blessed position of having the capital we need for the commitments that we've made, but that's not true of much of the space.
I remember Lucas telling me that the only number he cares about is ROIC. And
That's exactly right.
So that's exactly return on investment capital. So I think that's the most important part. I want to change the subject a little bit. Talk about the distressed debt and the debt market. Amanda, I think you were probably want to talk about that. What's happening with the miners, knowing that they can't access the equity markets obviously anymore. Debt is the next big catalyst probably, but it is getting expensive. So how do you see this?
So when we think about equity for miners, the thing that is difficult, like Lucas pointed out, is that what dilution are you going to take? And we all know that miners are going to need more and more and more capital. It's not like it's a SaaS business, right, where there's like a scalability model. You need constant flow of cash to enable to expand against your peers. So that becomes difficult. So miners naturally go towards the debt side. The debt side is interesting because there's not too many groups that offer debt solutions to miners. And I think that pool of capital is relatively small too. So I think, debt is increasing in cost, right, for miners, and the pool of capital is becoming smaller. Then you pair that with just market conditions. We have that $1.9 billion, remember, that miners need. And you also have like the building and energy prices skyrocketing. You have, supply chain constraints on getting any infrastructure, and it's kind of like the perfect storm. That, coupled with the rise of all of these public miners for liquidity last year, right? They all said, hey, I'm going to do all of these things, and a lot of them haven't delivered on that. So I think, the market is becoming a little bit smarter on what miners are real, what miners are not real, and where can I deploy capital appropriately. Like I said before, I think when miners are looking for debt, the thing that is important is to find debt providers that take principal lending risk. So there's groups out there that right now that are trying to say, like, yes, here's term sheets to miners. And then on the back end, they're coming to groups like us and asking for financing, right? So like definitely like do your homework on who you're asking for debt from as a miner.
Gotcha. Lucas, you have a view on this?
No, I think Amanda captured it. It's maybe just a few moments on the history. Last year was just so different, right? You saw baby bonds, you saw conventional financing, and yeah, now it's really hard to come by. It's not, I wouldn't say that markets are completely closed, but it's really expensive. So there were a couple deals in the market recently at the corporate level. You're talking warrants. So there's a piece of equity in addition to very high interest costs and then very short amortization schedules.
What kind of interest are we talking about?
You're talking double digits. I would say kind of mid to high teens.
Gotcha. That's way different from last 6 months even, right? Jaime, you have a take on this? I mean, you're all cashed up, but if you were to have to raise money, what would be the perfect way of doing it?
Well,
and assuming the
there's
market
no
stays
perfect way to
this
money.
way as it is.
Yeah, I mean, rates are tough. Again, we're in a blessed position with such a strong balance sheet, great partners, optionality, because we have the stack that we do, and we haven't overcommitted our capital. So that being said, everything's in double digits. Like there's no way to raise capital in the single digits right now. Maybe a little bit on the infrastructure side if you're really aggressive and you have a really strong balance sheet, but that's the outlier. That's the exception. We did a single digit infrastructure-backed loan earlier this year. That's a great option if you can get it. But for most miners, especially the new entrants that are over their skis, this is the first time I heard that $1.9 billion number. That's a big number, I think. And I think if we look at your slide earlier, we're probably not at the red dots yet as far as the pain that's going to come for people that are not in a good position.
Can we get the slide back
You
up
have
again?
to think that $1.9 billion number was also miners buying at like $80 per terahash on average, right? So miner prices ASIC prices are going down. And like Jaime said, like she's not selling coin yet to buy Bitcoin ASICs, but as these miners are not able to produce what they said they were going to produce, I think we're going to see ASIC markets drop, and the people with dry powder waiting on the sidelines are the one that are going to win here.
I will add one more Wall Street adage. Buying begets buying, selling begets selling, right? So like folks who have some dry powder, they're seeing the 1.9 billion that's needed. They're like, I'll just sit back, I'll wait, and we'll get to capitulation and things will
And go from there.
Yeah, I think we're somewhere between fear and desperation. Like we're definitely not at the bottom.
Yeah.
I love all the optimism you guys are throwing out there.
I'm sleeping like a baby, just FYI.
Oh, and
So is Amanda.
there's opportunity, right? I think there's opportunity for the space because, 24 or so public miners today. It's too many.
Let's talk about that opportunity. Let's talk about M&A. And we have heard a lot of rumors going around. I'll leave it up to you, every one of you, to talk about this M&A because I think it is very important what's going to happen or what probably is happening in the behind the scenes.
I think M&A is going to take all types of shapes and sizes and forms. So you have miners who have infrastructure built out, you have miners who have ASICs, you have miners who might have like access to capital that others don't have, and I think that it's going to look very different in the public markets like 2 years from now. I think, one thing that
Could you define very different?
I think it's hard to tell, right? Like, there's different strategies, like we say, like all miners are not created equal, right? So you see some people putting out press releases right now that might feel desperate, but it might just be because they're holding cash before.
Press releases are never desperate.
What's that?
Press releases are never desperate. It's always, we're pleased to announce, but anyways,
Yeah,
go on.
yeah, exactly. No, the press releases in mining is a head scratcher for sure. You press release when you plug in like one machine. It's like, congratulations, you've done your job. So yeah, I think that like M&A, I wish that I had like a crystal ball of how it's all going to play out because with Galaxy's balance sheet and just our position both being a miner and a lender, like that would make my life a lot easier. But I don't have that crystal ball, and I think that, in mining we could never truly predict exactly what's going to happen. Like, take China last year, that completely changed how the entire mining industry looked.
Lucas, if you were to put your investment banking hat on, what would be your take?
So I'll start with saying what I would like to see and then get to the bottom of your question. So I would love to see stock-for-stock deals, right? You can do M&A without raising capital, right? Two groups can come together, and I think Amanda mentioned kind of the best-case scenario. It's symbiotic. The different parties bring different things to the table, and together they're going to get through this tough period much better than independently. And again, you don't raise money. It's a stock-for-stock deal, and I think that's where the challenge lies today. That how do you allocate? Right? Everybody thinks they're undervalued, right? Nobody wants to, swap into a different equity when they feel like, 12 months ago we were 5 times what we're trading today.
Every miner also thinks that they're worth like $100 million with like 1 petahash up, right? So
yeah.
I think reality needs to set in for miners this year.
So be more realistic and be more conservative, and then.
And not to beat a dead horse, but we'll get there, and it tells you we're not quite at capitulation yet. Because if we were at capitulation, we would see more deals, in my opinion.
That makes sense. Jaime?
Well, we closed our first M&A transaction earlier this year when we purchased the data center business from TerraGo, and that was part of our diversification strategy. It gives us an uncorrelated fiat-based cash flow. It gives us infrastructure that we can build out to support the Web3 ecosystem. So we're super excited about that. And we've been public that we'll continue to grow both organically and inorganically. But I agree with Lucas. There is not yet a rational view of valuations.
Gotcha. This is a completely separate question. Is that what is the sentiment? And I was in the Miami conference as well, and it was gold chains and Bentleys everywhere. But what's the sentiment here? That obviously markets has changed since then. What are the moods? What are people talking about? Is it complete panic? Are we in the panic with everyone? Or
no, not at all.
What are they saying?
I'd say it's like slow and steady, right, are the groups that will do well. I think miners are generally worried about capital raising, right, and access to capital. But I think that the good miners are always worried about that, right, like to Jamie's point. In my mind, the best time to become a miner is in a bear market. Like, this is the greatest time to be a miner, not in
But
a
how
bull
do you
market.
become a miner in a bear market if you can't raise capital?
You scale appropriately and at reasonable levels. Like, you don't have to be 25 exahash by the end of the year. Like, it's okay to not do that, right? So I think, setting realistic expectations, setting realistic, risk perimeters of what your company is going to do, expecting, capital from providers, and knowing that you might pay a little bit extra because of the markets, but adding that into your models is really important. So, miners I think there's availability for them to grow and scale at this point, but they just have to do it in a really productive way. And I think last year we just kind of got in this crazy whirlwind where anyone could become a Bitcoin miner.
Right. Does that translate to retail miners as well? Can they still make profitably mine and make money?
I think that there's some really good services out there that are helping retail miners, and obviously, full disclosure, Investor and Compass. I think they've done a good job. I think there's realities around energy prices increasing that we all need to be aware of, right? That's going to affect not only regular large institutional miners, but retail miners and everyone else in between. And obviously all of us for our own energy bills, right? That's all, we're all paying more for that. So then your margins become smaller on the mining side. But I still am a huge fan of retail mining. I think it's a really cool way for people to get Bitcoin access. And there's other solutions too, that you can do it at your house versus it not being a service. So upstream data, what Steve Barber is building with his black boxes, you can buy a little box connected to your house and mine, with 1 or 2 ASICs, and ASIC prices going down, it's a beautiful time on the secondary market to buy machines. So I don't know, the plebe in me loves that there is an opportunity for anyone to mine Bitcoin, because like 4 years ago, that wasn't really the case.
Talk about the cost. Lucas, I'm going to go to you. What's the average break-even cost for the miners that you're seeing, and that's in your model?
Yeah, so obviously there's the cash break-even, and then there's the economic break-even. So when you talk about cash break-even, 10 grand, up to 15 grand, depending on
Per Bitcoin.
Per Bitcoin, thank you. And it depends now increasingly on the power rates, right? A year ago, a lot of these companies were underwritten with 3-4 cent power, and you look at spot power prices today. I mean, you have up to $120 per megawatt hour, and so really, what wholesale prices were on the power side. What retail prices were on the 12 months ago are now wholesale prices on the power side, right? So for institutional miners, that's a big change. Now, when you amortize the equipment 3 to 5 years or so, you're talking about a total break-even in the $20,000 range. So including the equipment, if you amortize, again, depending on how you amortize.
So margins are kind of tight right now.
That's right.
Jaime, what's your take on this? What the cost and what kind of power? First, remind us what kind of power costs you're getting.
Yeah, so our power cost differs by site. We built a new site in North Bay that just started mining last week. We've got 50 megawatts live. That's behind the meter at a very aggressive fixed power price. But again, we signed that deal in the bull market, which is what you want to do. And I was very worried about long-term power pricing, and so I wanted to lock us in on a fixed price PPA. So that's what we did, and that helps bring our average cost of power down, because we do have market exposure at our other sites in Alberta.
Right. Let's talking about the power and energy cost. I want to talk a little bit about ESG part of it. The next panel is about ESG, but since ESG ties into investor sentiment, are investors looking at ESG as a whole when they're investing into mining companies? What are they saying?
Yeah, I would say the large institutional investors looking into mining companies are absolutely looking at it from an ESG angle. I think that some ESG investors in the space are a bit lazy. They're not looking at who actually is doing the right thing in terms of like where they're getting energy costs or like where their energy is sourcing. Like if there's a perceived problem that Bitcoin mining, which by the way uses less than 1% of energy, actually uses 0.1% of global energy usage, right? If we're upset by that, okay, fine. But like if you're going to invest in an ESG company, invest in a company that is actually trying to get sustainable usage or sustainable power sources. I don't think that like things like RECs and credits are really the way forward for ESG investors. It feels, like I said, a bit lazy. So, I think there's some ESG investors that really understand the space, and like mining is the best ESG investment that you could possibly have. You just have to do your homework.
Because you wanted to say
something. I'll add one thing. So investors are, I'd say, really concerned about regulations. And so when ESG overlaps with potential regulatory headwinds, that's when they get really concerned. So I wouldn't say like my phone is ringing off the hook, people asking like, oh, what's the most ESG friendly play? But it rings off the hook when New York State puts forward bills that are limiting crypto miners, and then they want to know who has exposure, who is at risk here, what's the impact. And so I think that's, the regulatory, so when ESG is believed to overlap with regulations, that's when that's when investors get really concerned.
Gotcha. Jaime, you had something to add to that?
We're on the front foot with ESG. We've made public commitments on the E and the S and the G. I think we often talk about ESG, but all we are focusing on is the E. So we've been very careful to have a programmatic approach to the entire space. We've made commitments. We recently released our first report on our ESG results year over year. We're committed to being carbon neutral by 2025. We do have offsets as part of our program because we are based in Alberta. Our primary mining sites are in Alberta, which is dependent on natural gas and wind. So we have to have offsets as part of that program. But I think the most important thing when you're looking at miners, and again, not all miners are created equal, what is their ESG program? What are their commitments? How are they holding themselves accountable? What third parties are they using to make sure that it's not just greenwashing, it's not just headlines, it's not just press releases, like they're actually doing the work. So we pride ourselves on actually doing the work and making hard decisions, but hard decisions that we think are important to be on the right side of what's best for community at the end of the day. Because I think sometimes we lose the plot on what Bitcoin's here to solve for. And it's here to solve for community and for the people, and we have to do that in the right way in how we operate in all things.
That's a great plug for Bitcoin. We have about 4 minutes. I want to get each and one of yours outlook, if you want to take out your crystal ball and talk about the mining space. Let's start with Jaime first. What's your outlook going forward for the industry?
You've got that chart. I'm just looking at depression. I would like to skip through panic and depression and get to hope and relief. Look, I think we've already touched on it. We're going to have consolidation. I think this is a great period for actually focusing on execution and building. I think last year was overheated, and I think people that maybe weren't focused on execution and building and operational excellence are going to get washed out in this cycle, and I think that's a good thing for the space. I think at the end of this cycle, the strongest will survive, and we'll have a better peer group going into the next market, and I think that's important for the space.
Amanda?
Yeah, I think that I agree with everything Jaime said. Things that are exciting for me, for miners, is like really the treasury management to set them apart. I think that that's going to become something really important. I'm also really excited about like Lightning finance, so things being built on top of Lightning that miners can leverage. I think there's a lot of work being done there that is cool, and I also think that hash rate derivatives is inevitable, right? Like that's coming, and that will also be another tool that allows miners to grow and scale. So,
can you explain a little bit what you mean by hash rate derivatives?
So using hash rate as a hedge instead of your Bitcoin production. So, a miner can say like, hey, like I have, let's give an example of like 500 petahash. I will hedge out or sell 100 petahash of my hash rate over a certain period of time to be able to get that Bitcoin that I think it will produce. So I think there's, some really great groups, including us, looking into that as an option for miners. So I think, treasury management is really going to be important over the next 1 to 2 years in this bear market cycle. But like Jaime said, like miners have to keep their head down and just keep on building, and that's like the best thing that they can do.
Gotcha. This is a time to build.
Time to build.
Lucas.
Yeah, I think so. This is the time the wheat gets separated from the chaff, and at the end of this process, you'll have an industry that is even more efficient, even more rational, that uses all the tools that are available.
When you say efficient, what do you mean?
Well, so their efficiency across many axes. It comes right. There's treasury management. There's operational management, right? Efficiency. So it will be a fleet that is more efficient. It will use what is state of the art. Just have the lowest break-even cost per Bitcoin, as discussed earlier. That is truly in places where power is stranded, right? We are in a world where power prices are rising. The competition on the power side will intensify, and so Bitcoin will even more gravitate towards the areas where power is cheap, and that's a form of efficiency. And yeah, I think there will be, and I think another area will be capital efficiency. How much do you pay per terahash? I got a little carried away, and I think going forward, Wall Street will look a lot more closely as to how much is paid for equipment.
Gotcha. That sounds like we have some hope, hopefully, out there. We're almost out of time. Thank you so much, Jaime. Thank you so much, Amanda and Lucas. It was a great. Hopefully, that was some good, informative session for you guys. We'll get there. we'll get there. We're building, and we will make it through the tunnel.
Absolutely.
Hopefully. All right. That's it.
Thank you.
Thank you.